And Dan, I got to start with Apple. Our pro subscribers heard it yesterday, your reasoning, but tell it to our broader audience. You actually call Apple, quote, the most overpriced tech stock that exists. Tell us why.
Yeah, I mean, in terms of big cap tech, it clearly is in my mind, because if you look at it in terms of how much they're growing relative to the multiple, it just doesn't make any sense, right, relative to the other mega caps. So Apple's revenues compounded over the last 5 years, including this calendar year, because we only have about a quarter left, is growing about 11%. Microsoft is growing about 15% over this time. Google's at 23, Netflix is at 27, Amazon's at 28, and Facebook, given all the discussion about the metaverse, they've grown revenues compounded at 34%. Well, you can buy both Facebook and Google at a lower multiple than Apple. And don't forget, Apple's a massive pandemic beneficiary. And so for them, their iPhone revenues over the last 5 years, fiscal 15 to fiscal 20, were down 11% over 5 years before you had this pandemic benefit. iPad, Mac sales were also down year over year before the pandemic hit. So, for me, we like Facebook a lot. We like Google a lot. They're growing 2 to 3 times faster, and you can buy them at a lower multiple with faster growth rates in the future. And we haven't even gotten into the risks around privacy and what that does to their app store take rates.
Right, Dan, then how much weight do you put into the services piece of the Apple story? I know still a relatively small portion of revenue, but if you think that during the pandemic they were a beneficiary and they were able to grow that installed user base, could that not provide greater than expected growth?
Well, don't forget, that's the whole reason the multiple's gone up so much despite the growth that they've shown. So if you're looking forward in time, I think it's pretty clear that all of these companies are trying to get the take rates down. They had that ruling against them with Epic. And you've got pressure across the globe, not just from Europe, but also in the US, in terms of what they're charging, that 30% rate up front. If those numbers start to come down, this multiple is going to have a big problem because their core hardware business is, flat to declining. And that's just because of, 4 billion people on the planet have smartphones. So that's the big risk. And that's only going one direction. It's going lower. It's not going to go higher with those take rates.
Dan, I'm curious about your thoughts on this clash that we've been talking about between Apple and Facebook. First, whether or not you think that Apple's operating system changes are going to continue to challenge Facebook and others through next year, and also whether you think Apple's really going to be investing heavily in the metaverse space that Facebook has staked such a claim in now.
Yeah, you have to sort of step back. The good news is that a lot of these companies have gone through and reset their targets. So for Facebook, for example, you're now looking at 3% EPS growth as the forecast for next year. I'd be shocked if the number wasn't a lot better than that. Because Facebook, when they report their September quarter, they always guide out and then they lay out what their expenses are. I don't think they've ever come in at the mid to high end of expenses. They've always come in sort of mid or even below the expense guide they've given, despite the fact that the revenues typically come in higher. So I think, from that perspective, Facebook is clearly one you want to look at if we're talking about the metaverse and all those great things. But you're right. From Apple's point of view, they're going to have to think about that. If that's the next step, they're going to have to think about how to invest in that space. And that's going to be expensive for them if that's the path that they're going to go down. And I think that's kind of where every company's headed.